Welcome, Bitcoin friends. It's Bitcoin Mamo. Today we're going to look at the Bitcoin charts, do some TA. We'll be comparing the different cycles for Bitcoin, both on a percentage gain basis and also a time basis. And we'll also be using fib levels to make predictions with our current cycle compared to previous cycles. So let's get straight into it. This one will be a bit of a different video. Just quickly, we will check the Bitcoin charts, but everything I mentioned in the previous video a couple of days ago is pretty much all relevant. Nothing much has changed here. The key thing I'm looking for me to know that a bottom is in on this pullback is the hash ribbon buy signal. And also we're looking for a possible major green dot here on market cipher on the daily time frame. If we just get a regular green dot here, which are the ones when the blue wave is more above this white line, then I'll also need to see a regular 2-day green dot print. I think the hash ribbon signal will take the longest out of the three. That alone would be enough to tell me that the previous low was the bottom. Otherwise, I need to see at least a major green dot on the daily or just a regular daily green dot along with a 2-day green dot. And for any more information, again, watch that previous video from 3 days ago. So let's get on with the main content for this video, where we will be comparing the different cycles for Bitcoin in a number of different ways. So we're going to start here looking at the cycle where the bear market was in 2014, 2015 consolidating near the lows, and then the 2016-17 bull run. And the main things we see here are there are three key levels here, and the next level is the previous all-time high. And these are the three key levels where we did see resistance. And we also saw after breaking that resistance, we always had a pullback to retest that previous resistance, and we flipped it into support. And then we formed our next resistance level. Again, it broke that key level, had a pullback, tested that previous resistance, flipped it into support, did the same thing one more time here, broke to the upside, pretty much where the all-time high was, had another pullback to previous resistance, flipping into support. And then we did get a rejection from the all-time high and one more pullback. And then the most explosive part of the bull run after that, which was from March 2017 to December 2017. But these were the three key levels here on our way back to the previous all-time high. Now looking at our current cycle here, we did a very similar thing. We spent 2022 going down, again comparing that to 2014. We spent about 9 months at the bottom here, consolidating at the lows. We had this level of resistance. Once we broke above it, we moved to the upside, had a pullback, tested that resistance level, flipped it into support, and now we have moved back to the upside, and we're getting resistance again at that previous resistance level. So we have already pulled back to this previous level, flipped it into support, and now I think we're just going to spend time going sideways here, perhaps making an ascending triangle, as we spoke about in the previous video. But once we do break this key level, I think we see the next move to the upside. We'll go into why this yellow line's here, for there could be two possible places here. I think we'll do a similar thing. We have a move to the upside, a pullback, a retest of that previous resistance, flip it into support, and then make our way to the previous all-time high. And upon breaking that, we'll see that more explosive end to the bull run, which would most likely be in 2025. So let's look at some fib levels now. And on all of these different fib levels here, we're always going to be using the golden pocket. The golden pocket is the 0.618 and the 0.65 fib inside that zone. This is based off the golden ratio in mathematics, appears a lot in nature and also works in the markets. We can see taking it from the top of this dead cat bounce here down to our low, we get that golden pocket area, and we saw that's exactly where the resistance level was twice here. We are using the fib levels based on the log scale. I think the log scale is more relevant on a more macro analysis over several years on a chart rather than short-term analysis. We're going to be using a mixture of log and regular scale when looking at fib levels. So this one is based on the log scale. Now the next fib level we're looking at here, again the golden pocket area. We're taking it from the top of this dead cat bounce down to our low, and we see that golden pocket pretty much in line with this resistance level, like this golden pocket here was with this resistance level. And this golden pocket is based on the regular scale. This one was the log scale, but we are seeing these golden pocket areas from the previous tops of dead cat bounces down to the bear market lows are lining up with the key resistance levels. on our way back to that previous all-time high. And finally, the overall retracement from that all-time high down to the bear market low. We see the golden pocket again up here. And this one is also based off the regular scale. It doesn't line up exactly with the level of resistance here. But again, with this cycle, the lows here were different on different charts. We see this was a lower low here compared to that one. But other charts, this was the low. So there is a little bit of variance depending what chart you're looking at. I'm using the Bitcoin all-time history chart that TradingView provides because it has the most data. But the key takeaway here is that these golden pocket areas are a good indication of where these key resistance levels are. And so we're going to use this with our current cycle to possibly make a prediction on that next key level. So to our current cycle now, this was our first key area of resistance, and we notice a golden pocket again, taking it from the top of this dead cat bounce down to the bear market low. We get that golden pocket. This one is on the regular scale, not the log scale fib, but we do see it does line up pretty much exactly here with that previous resistance level and also the support on the pullback. Pulling up our next golden pocket area, taking it from the top of this dead cat bounce to our bear market low. We see that golden pocket again. Again, it lines up pretty much spot on with this level of resistance. And this one is based on the log scale. And the final golden pocket now, taking it from our all-time high to our bear market low, we see a golden pocket comes in here at about 50K. And this one is based on the regular scale. Of course, we don't know whether the log or the regular will be the key one where we get resistance here. But this one does line up nicely with this previous top here. So this could be the key level. And if we switch to the golden pocket on the log scale, it comes in here at about 40K. So these are the two possibilities here. We can just mark it with both of these yellow lines. Perhaps both will be significant. But if we are to do the same thing as that previous cycle, we only had 3 key areas of resistance before we got to that all-time high. So these will be the areas I'll be mainly watching as we finish off the year, go into the halvening. And as mentioned in previous videos, I think we're somewhere here with our current cycle where we have been getting resistance several times from a key level. And I think we're going to make higher lows here while we're forming this ascending triangle and eventually break this key level. And again, it can take a while. This pattern here basically went from the start of November to May of the next year. About 6 months there. That would say we break this key level if we were to do a similar thing sometime in October, if we were to spend 6 months in this range. And I think we form some sort of ascending triangle here. And the last 3 months of the year will be quite good, pushing up to this next key level. That's all for this chart, so let's move on to the next one. So this is the same thing with all those fib levels marked out. I've just put them side by side, but I've also added in the 2-day Ichimoku cloud here. And we can see on all these pullbacks here that we pulled back into that cloud, and it did act as support here. We had the next move higher, acted as support, and we saw that all the way up as we broke that all-time high. And we are seeing similar things with our current cycle. This pullback came to that cloud, this one also, and we can see currently where this cloud is. The bottom of the cloud going until 9th of August is at 25.3K, and by the 13th of August it would be all the way up at 28K. So I think we possibly could come down into this cloud again, get support, again make a higher low and form that ascending triangle. So just interesting looking at it side by side there. We are doing very similar things, and I have saved all these charts so we will follow it in the bull run. And on to the next chart. Now we're going to look at more of a time-based analysis when looking at cycles. This does look a bit complicated here. We've got lots of stuff going on this chart, but we will go through it, and there's different ways to look at cycles. It's not necessarily as clear as we think. But basically, these yellow lines are the halvening dates. The next halvening is expected sometime in April. And this first yellow line is actually the day that the first Bitcoin block was mined in 2009. And we do see the TradingView chart, the Bitcoin all-time history chart, does go back to October 2009. So we do have a lot of data here. This was where the first block was mined. So I have also marked that as the beginning of this initial cycle here. But this is very different to our other cycles as it was early on in Bitcoin. So I tend not to look at this cycle when comparing all the cycles. But let's go through the other things here. I do have the number of days written here. Obviously, this first cycle from when Bitcoin was created to the peak of this first bull run was about 833 days. And then we had a very short bear market, 161 days. And then the next bull run was about 742 days. And then things aren't as clear after that. You can see, just zooming in here, when we look at the bear market, as mentioned with that other chart, we did have a double bottom here. And we'll just zoom in to make that a bit clearer. We can see we did have a bottom here and a bottom here. And on some charts, this was the lower low. On other charts, this was the lower low. So we can't know for sure exactly which one is the bear market low, just looking at data and charts. So we have 630 days if we use this as the bear market low, and 413 days if we were to use this as the bear market low. So this red square is for that number. This one, obviously the bigger one, is for that number. Then we had the bull run, 2015, 16, 17. This was 847 days. The bull run could also be seen from this low, so that would be 1064 days. So again, there are two possibilities here. Then the bear market in 2018, 364 days. And our most recent bull run here, again, we had a double top here. Technically, looking at the indicators, it said that this was the bull market top. But looking at price data, this was the higher price. So again, it's a little bit arbitrary, like this double bottom here. And so the bull run could be 854 days or 1057 days. And so it changes the next bear market also, taking it from this high, 588 days, taking it from this high, 378 days. So which one is correct? And when we do compare cycles, looking at bull runs, bear markets, or using the halvening, we do need to look at both because we could see some signs and patterns there. And if we just look at one, we may miss those patterns. So if we just look at the top numbers here, not the bottom ones, what we see is that this bull run was 742 days, this one 847, this one 854. So we do see pretty similar numbers here with all of these. And we could even use this one starting from when Bitcoin started, 833 days. And we do see it pretty much lies within a 100-day range here. Looking at the bear markets though, this one would be 630 days. Again, we're using this low because we used this number. So we use this low as the starting point of the bull run. So the bear markets would be 630 days, 364 days, and 588. So there is a bit of a difference there. These don't really line up as well as the bull market number of days. But let's look at the bottom numbers now. This bear market here, 413 days. This one doesn't change. It's 364 days. And our most recent one, 378 days. And we're using that second bull market peak here. So we do see they are quite similar within a 50-day range, which is pretty close. And then we can use the corresponding numbers corresponding to these bottom bear market numbers. And if we do that, we get 1064 days on this bull run. Again, starting from this low, because we use this bear market going to that low. The next one would be 1057 days. So these are very close, within 7 days. And using the bottom numbers, the bear markets are also very close. So perhaps this is more accurate here. If we do use all those bottom numbers, it means this was the bear market low and this was the bull market peak. But that isn't the end of the story there. If we do look down here, we have some more numbers, and this is basically measuring from the halvening date to the peak, and also from the halvening date to the next bear market low. We've done that for the previous cycle and our most recent cycle here. This one is nice and crisp. We have 546 days. The halvening is a definite date, and there was only one peak here. And the bear market also, there was only one low here, not a possible double low. So these numbers are reliable looking at this data. Looking at our current cycle here, taking it from the halvening to the second bull market peak, we notice it's 539 days. And taking it from the halvening to the next bear market low, we get 917 days. So we notice these numbers are very similar to the previous cycle's numbers. only a 7-day difference between both of them. So this suggests that the accurate model here is these lower numbers, telling us that this first bear market low and this second bull market peak are the accurate ones to use. The other interesting thing here is we're questioning which peak to use here. And we have been comparing this cycle with the previous cycle down here. And if we were to take a fractal here of this price action coming back to the all-time high, we would initially assume we put it at the peak, which was this peak. But when we do that, we do see that at the same point in time here, we were actually right near the bear market lows, making that double bottom. Whereas in our current cycle, we've doubled our bear market low price. But the interesting thing is, if we do put it to that first peak, we do see that the second bear market low here on this double bottom does line up with our current bear market low. And we see how similar this pricing action is. And it's actually in the same spot as what we've been comparing. We've said we're in this ascending triangle pattern here. And we actually were in that previous cycle. Again, we're comparing this area here where we form this ascending triangle with our current price action in between both of these golden pocket areas. And they do line up when we use this as the bull market peak and start the fractal. So this from this point with this point. And just to make it clear, this is what I'm talking about here with our current cycle. I think we're forming this ascending triangle pattern. But again, we can see how using that first peak, this does line up pretty much exactly. And we mentioned we'll see this next move, perhaps not until October, perhaps a little bit earlier. But it is interesting how different it is if we do use that second peak. And the interesting thing to note is if we do this same fractal using this first peak, again, this white line is the halvening date. It would mean by the halvening date that we would be testing the previous all-time high, somewhere around 65 to 70K here. And we may see a big pullback before that halvening date. So it is quite interesting. And we'll see if we keep following this fractal, we get one more big move in the last 3 or 4 months of the year, another big pullback. And then as we approach the halvening in the first quarter of next year, perhaps we come up and try to test those previous all-time highs. Just something to keep an eye on. We can always look at it from both points. And if we just end up going sideways for a long time, or we dip and go back up, perhaps we stay in this range until close to the halvening, where then we see that move. But I think it's important to look at both perspectives. So let's look at both of these side by side now. Up the top is obviously our current cycle with that double top peak here, and down the bottom that cycle we've been comparing to. Again, 2014 bear market, 2015, 2016, 17 bull run. And I've lined it up and we're looking again at a time-based analysis. And as mentioned, they do overlap quite good when we line up the peak in 2013 and this cycle with our first peak with our previous bull run here. So we have lined both of those up with these white lines. Then we have also lined up the peak of this dead cat bounce with the peak of this dead cat bounce, and then the peak of this dead cat bounce with this dead cat bounce. And these are the projected lines here where we might see that next push to the upside. And I have lined up here, we did have this massive wick, so this was the highest point. I have lined it up here. This wasn't the highest point here, but it seems like we had that move to the upside. We just didn't get that big wick. Again, we could line up different areas here. If we did line up these peaks, we can see it's fairly close. It's not 100%, but it is just a fractal here. And again, I think we're doing something similar to this area. This is where we formed an ascending triangle. We spent 6 months here. We are below this white dotted line, which was around about the base here of support in the initial dead cat bounces. And then we spend a long time below it. And I've done the same thing on our current chart. Again, I think we're doing a similar thing over maybe 6 months, form an ascending triangle here. And we have this white dotted line just around about where we have this base, also the top of this dead cat bounce. We see it does line up approximately with the similar price action we've been comparing. And again, we said they're very similar when we use this first peak here. And if we actually measure it from the peak here to the top of this dead cat bounce, it's about 350 days. We do the same thing on that previous cycle, this peak to the second dead cat bounce, it's 343 days. So we see a very similar amount here. So we are using the same time here. And again, if we took it from the peak to this next white line here, where we're making this ascending triangle, do the same thing with our current cycle, the peak to this white line, where we're making this ascending triangle. This one's 728 days, this one's 721. So again, it's very similar based on time here when we do line up the peak of this cycle with our first peak on our previous bull run. And when we do that also, again, these are the same amount of days here. It does line up very well from the bear market low to our current point. We are also below this white dotted line on both of them. So it is very curious that it does line up with that first peak a lot better. And again, that would suggest that perhaps we test the previous all-time high sometime approaching or just after the halvening. If we were to line up on this chart, it would put us sometime in July next year that we would be testing that all-time high. Now we can also add in the 21-week exponential moving average. We talked about this in the previous video, how generally in bull markets, we pull back to it and it acts as support. We can wick lower, but generally the bodies of the weekly candles close above it, as we can see with both of these pullbacks. And when we do compare it with that previous cycle, we see a similar thing coming off that bear market low. We pulled back to it here, almost touched it here, but pretty much the average caught up. And then we did bounce off it here and have that next move to the upside, acted as support all the way up in the bull market. So this is also very similar here. Obviously the big difference here is this was a higher high on this dead cat bounce, if we're calling this the technical top, whereas this one was a lot lower. And you could say that this top was manipulated. We had the China FUD, we had Elon saying you can't use Bitcoin to purchase Teslas anymore. And it seemed very manipulated. We had that 50% drop, and it seemed like big money needed to get out. They missed the top, so it did manipulate a rally back to the upside, get the hype going again, and then they were able to get back out at the level they missed out on. And we were expecting a big explosive blow off top here. We didn't get it. If we would have got it, say to 100K, it would have looked very similar to this. This would have went to 100K, this one to 70K, and we would have had that same type of pattern. But either way, you make your own mind up. It is interesting looking at all the scenarios here. And again, I'll have saved all these charts so we can follow it along in the bull run and see if that plays out. So let's actually compare these cycles now using those different variations. Again, we talked about how there were two possible bear market lows here and two possible bear market highs here. So let's actually overlap these cycles and look at the percentage gains from different starting points using both of these highs and also both of these lows and see what we find. So the first comparison we're going to do, I've highlighted it with these green squares. Again, these white lines are the halvening dates, and we're going to compare from halvening to halvening on all three of these cycles, 2012 to 2016, 2016 to 2020, and 2020 until our next halvening in 2024. So when we do that, we get a chart that does look like this. This is on the log scale. And basically that first cycle is in blue here, the second cycle in red, and our most recent cycle in yellow. But what we see using the halvening as the starting date, we see the first peak on that first cycle here, around about 360 days in. This is the percentage gains here on the y-axis, number of days on the x-axis. With our next cycle here, the 2017 bull run peak, that was about 510 days after the halvening. And looking at our most recent cycle, the first peak here was similar to that first cycle, around about 320 days. And the second peak was similar to the second cycle, about 520 days. So very interesting how our most recent cycle was in a similar time as both the previous cycles, but we just had a peak for each. Looking at the bear market low here, it was very similar to the previous cycle in red. Again, this was around 2018, I believe. Whereas that first cycle where we had the double bottom in blue here, we see one bear market low here and the next one here. And again, if we didn't have the FTX collapse here, I think this would have been the bear market low at around 17K, and that would have lined up with that first cycle low. But with the FTX collapse, it does line up better with the previous cycle in red here. But again, it's just interesting to look at. And the second thing we're going to look at is looking at the percentage drawdown from the top of the bull market peak until the halvening date. We're doing that for all 3 cycles. And in this example, we're using that second peak. We will also look at the first peak, but that's on the next example. So using that second peak, again, from the bull market peak to the halvening. When we do that, it gives us a chart looking like this. The blue line is the first cycle, the red line the previous cycle, and the yellow one our current cycle. So we are in about 628 days since our peak, and currently we're sitting about 55% down from that all-time high. Looking at the same number of days here, the previous cycle was pretty similar, about 50% down from its all-time high, and the earliest cycle in the blue here, we can see it was still about 80% down as we form that second low on this double bottom. They're very different again, and again we're using that second peak, not the first peak. And we can see by the time we reach the halvening, the earliest cycle here in blue was down from the all-time high about 40-45%. The previous cycle in red was down about 60%. So it will be interesting to see what happens here. So let's use the first peak this time and see how it looks when we overlap all 3 of these, just so we can compare both of them. When we do that, we see the earliest cycle in blue, the previous cycle in red, our current cycle in yellow. Again, we're using that first peak, so we can see the second peak here, which did go slightly higher. So it was a percentage gain, not a loss there. And it does stand out as being quite different here. But when we look at our current position, it is quite similar to the other 2 cycles. And we see that second low here on the earliest cycle in blue here does line up pretty close to our bear market low on our current cycle in yellow. And also the rally here, we are slightly higher on a percentage basis. But again, I think we're doing this ascending triangle pattern, if we can see it here in blue, with our current cycle. And using this comparison, it would say that the next move to the upside would be in about 100 days, 90 to 100 days, and that would put us somewhere in early October. But if we do use this as the peak, the halvening would be much further down here. Halvening would be at around the 1070th day, so a bit off the screen, and that yellow line would be just off the screen here. It would still make sense. We can see quite a gap between the previous cycle in red and the early cycle, measuring it from that all-time high to the halvening date. So it's not completely out of the question to have the yellow line go all the way just off the screen for the next halvening date. But the interesting thing is, and we looked at that chart where we compared the time-based analysis, looking at both the cycles, we saw using that first peak that we had this second peak here, which we were saying it was massively manipulated and overreactive dead cat bounce. But we see how well that lines up with the one in blue here, which is that first cycle we're looking at. Both of these dead cat bounces do line up on a time basis around the 200-day mark. And also the next top of the dead cat bounce here lines up with the top on that first cycle of this dead cat bounce. So there are similarities on a time basis, even though the percentage here is quite different. And again, we look at all possibilities here and you can make up your own mind. But let's move on to the next one. This is comparing the cycles from the bear market low to the halvening date for all 3 cycles here. And on this occasion, we're using that first low here. Again, this was more of a double bottom. Depending on what chart you look at, the second low here was sometimes lower. But we're using the first low on this example, comparing it from the bear market low to the halvening. And when we do that, again, using that first bear market low in the first cycle, we get something that looks like this. So the blue line is that first cycle, the red line the second cycle, and the yellow our current cycle. And we are about 250 days since that bear market low. And we see how big of a move it was with our previous cycle in red. This run up in 2019, where we had 300% gains off the bear market low after about 200 days. Whereas our current price action, we had pretty much a double, gone from 15.5k to 31k. Whereas that first cycle, again using its first bear market low, actually made a similar low after 230 days. They are quite different here. Again, on both, we saw a rally going into the halvening. and then we saw a pullback just before the halvening. But let's use that second bear market low now rather than this first one and see if things look different. So we're looking at all the possibilities here. And here we go. The blue one is the first cycle, the earliest one, the red one, the second cycle, yellow, our current cycle. Again, we're using that second bear market low. So that does alter the blue line here. But what we see is it's much more similar to our current cycle now. And if we just isolate those two together here, we can see how similar they are. Again, using that second bear market low. And we are quite similar here, close to about 100% of that bear market low. So a doubling in price. And if we compare it like this from the bear market lows, it would suggest the next rally would be at the 275-day mark here. So in about 40 days or so. So if we are to do a similar thing here, have quite a big rally here, this could be quite a big move for our current cycle. We can see we went from about 100% up from the lows to about 250% up. So 100% for us in our current cycle is 31K. 200% would be 46.5K. And if we went 250%, that would be about 53K. And then we possibly pull back to about 3640K here if we were to follow a similar pattern. But it is interesting using that second bear market low, how similar these are. And again, you can make up your own mind which one you think's right. I think it was important to show all the possibilities there, and it will be exciting to let this play out and see which one was most correct. So just going back to this one, we've got all three cycles, again from the bear market low, again using that second bear market low. What we notice is using that second bear market low to the halvening date, that would put the halvening here happening in the first cycle after about 320 days. For the second cycle, the halvening happened after about 520 days, again from the bear market low to the halvening. So quite a big difference of 200 days there. That would suggest the first bear market low is more accurate, but we are looking at all the possibilities. So the next chart, what I've done is, even though these ones end at the halvening date, I've extended the price action of this first cycle to be in line with the second cycle's halvening date, just to project it. It does knock out the time-based analysis of ending at the halvening. But if we are following a similar thing here, it'd be interesting to see what the rest of this played out like. So that would look something like this. So the second cycle in red, the end date is the halvening date. The first cycle, the halvening was back here. I've just extended the price action. If we do a similar amount of days from the bear market low to the halvening as cycle 2 here in red, but we follow the same path as that first cycle using the second bear market low, and perhaps we could see two big moves here just before the halvening. And we see here projecting and doing this example, it was 400% up, which is 5 times the price. So if we did 5 times the price of our bear market low, which was 15.5, that would put this area at about 77,000. Now, I'm not saying that's going to happen, but if we did follow the same path, this is what the price projected would be. But again, we're looking at all the examples, all the different comparisons, and will be interesting for this one to play out as we get closer and closer to that halvening date. And we'll keep looking at these cycle charts. Again, all of these are saved and will be updated. And every month or so, we'll revisit these cycle comparison charts. But I think that's about all for today. We did cover a lot. It was a bit of a different video. I hope you liked all those different perspectives. I don't know if anyone else is looking at the different possibilities with cycle lengths. We did support arguments for both sides using either of these lows or either of these highs. And we have to let it play out to see which one is most correct. So thanks for watching. I'm Bitcoin Mamo. I'll see you next time. Bye.